Once again, in US trading on Friday night, we saw the major indices in the US diverge. And the reasons for that were pretty straightforward. Before the session began on Friday night in the US, we saw an inflation read, which we know that the US Federal Reserve pays a great deal of attention to. The core reading of the PCE on an annualized basis is the Fed's preferred measure of inflation. And unfortunately for markets, it showed a tick upward to 2.9%. And while that was widely forecast, that change in direction in the readings on inflation is a cautionary note for investors. It's one of the reasons why we saw selling in the US market on Friday night. Now, it's not surprising under that scenario where the potential for interest rate cuts could be diminishing, that the selling was concentrated in those stocks where we have seen the biggest gains and the most profits to be protected. And that, of course, means the high-flying tech sector. That, of course, means the high-flying tech sector and the semiconductors that have driven so many gains in that area. And so that pressure saw the Nasdaq down by 1.2% in trading on Friday night. The S&P 500 it fell by about half of that. And the Dow Jones Industrial Average actually held up pretty well. It was only down 2%. But it does go to show how the different composition of each of these indices can play out when there's a particular focus. And that tick upward inflation and the profit taking that inspired could spill over into trading in the Asia Pacific region today. Now, looking at that potential for a rate cut, although interest rate markets did back off somewhat from their expectations, they're still very high. And at the moment, interest rate markets are suggesting there's an 88% probability still of a cut from the US Federal Reserve at its September 17 meeting. So one to watch out for. It's very clearly baked into current market levels. And if we do see further data that erodes the idea, we'll definitely see a rate cut in September. That could weigh on share market trading around the globe and here in Australia as well. So last week we saw a modest fall in the US, a larger fall in Hong Kong, but the Australian share market actually managed to gain. And that's returning to a theme that we've highlighted over this second half of the year, and that is the potential for outperformance from the Australian share market. And we see that when there's pressure on those high flyers, because the Australian share market's composition with its focus on resource stocks and financial stocks means that when tech stocks are getting sold down globally, Australia is likely to continue to outperform. So something to watch out for if things start to sour, particularly at the macro level as inflation creeps higher and the potential for central bank support diminishes. So we come now to the end of the reporting seasons in the US, in Australia, in Hong Kong. And the picture overall is positive. Now, in the US, we saw outstanding contributions over the quarter, a 6% increase in revenue, translating to an almost 12% increase in profitability across all 500 of the S&P 500 companies. And that sort of solid result does justify gains in the market and the high levels potentially that we're seeing in those indices, with them all still very near to record highs. The situation in Australia was also positive, and we did see a growth across the board, but it was much more patchy than we saw, and some very good performances in insurance and in specialty financial groups, in particular mortgage insurance. The Helia Group distorted the effect somewhat in that those very good bounce backs and the increase we saw in profitability in those areas pushed both insurance and financial stocks to one of the best performing sectors for this half. A little bit of a surprise given how steady the banks themselves were and how much ballast they provide both to that sector, the financial sector, and to the markets. But nonetheless, those strong gains in certain areas were important. And we also saw very much a focus on individual stocks. Now, the Australia 200 index is up 6.5% or thereabouts in the past 3 months. So we did need to see some good reports. And although we were generally looking at weaker reports here in Australia than we were internationally, overall the impact should have been positive. Now, having said that, those averages really mask some huge swings in individual stock performances. And one that comes to mind is Tabcorp. Its shares are up 41% over the course of last week as it bounced back towards profitability, and analysts started revising up their estimates for Tabcorp based on the result it unveiled last week. Analysts are now bullish given the diminished share price for Tabcorp. Revenue was down slightly for over in a comparison with the past 5 years, but nonetheless, the pressures on the industry itself are well known, and on Tabcorp in particular, and the bounce back is coming from very low levels, and it's very clear from that big gain we saw in Tabcorp's share price last week that some investors suggest there might be bargain hunting to be had in Tabcorp. Another good performer last week was Austal, the shipbuilder. It jumped 15% after its result on Friday, and analysts say that its earnings could continue to be underestimated, particularly given its engagement with both the US and Australian governments on the provision of its littoral class of destroyers. And the deal that was signed just over 4 weeks ago with the Australian government means that the earnings pipeline is being firmed up. And on that basis, many analysts are revising upward their estimates, and the share price is moving in the same direction at the moment. In contrast to these strong performers, we saw James Hardie last week down 30%, and those shares are not recovering at the moment. We saw a second leg down after some real concerns about the deal that James Hardie management did without taking it to shareholders. That acquisition in the US and the relisting of James Hardie shares into the US was not given a tick by shareholders. That saw an initial very negative share price reaction for James Hardie, and the result we saw on August 19th just confirmed what so many are fearful of. Shares are still lingering at much lower levels, although some analysts have now moved to a buy rating on the stock. It does appear to be based on an optimistic integration of the new business in the US, and there are apparently shareholder rights firms investigating the circumstances under which this deal was done. Definitely not a positive for James Hardie. Overall, though, we're looking at a slightly negative start to trading here in Australia, with futures markets down around 25 points on Saturday morning. In Hong Kong, we could see a positive start, although the futures for Hong Kong closed before the US closed. They were in positive territory even after the release of the inflation data, so we might see a bounce back in Hong Kong this week.